Investing might sound intimidating when you're a teenager. After all, it's a topic usually discussed by adults or financial professionals, and it can seem like something far off in the future. But the truth is that starting to invest as a teenager can be one of the smartest financial decisions you make. Even though you may not have a lot of money now, the concept of compounding, earning interest on your interest, means that the earlier you start, the more time your investments have to grow. Imagine planting a tree. The earlier you plant it, the taller and stronger it will be in the future. That's what happens with your money when you invest early. Before we dive into how to start investing, it's essential to understand why investing can be beneficial. While saving money in a bank account is a good practice, your money grows very slowly there because of the low interest rates. Investments, on the other hand, typically offer higher returns, especially over the long term. However, it's crucial to know that with higher returns often come higher risks. Unlike the money in a savings account, investments can lose value in the short term, but historically, they've grown in value over the long term. So, think of investing as a long-term strategy rather than a way to make quick money. Your goal should be to invest for years, even decades, allowing your money to grow and withstand market ups and downs. Now, let's explore the power of compounding. Albert Einstein is said to have called compound interest the eighth wonder of the world. Why? Because of how incredible it is. Compounding means that your earnings start to earn their own earnings. For example, if you invest $100 and earn a 10% return, you'll have $110 at the end of the year. If you leave that $110 invested and earn another 10%, you won't just earn $10 again, you'll earn $11, because the interest applies to both your initial $100 and the $10 you earned. Over time, this compounding effect can turn a small amount of money into a substantial sum. One of the first steps for teenagers interested in investing is learning about different types of investments. There are various options, but some of the most common include stocks, bonds, mutual funds, and exchange-traded funds, ETFs. Stocks represent ownership in a company, and when you buy a share of a company like Apple or Tesla, you're investing in their future success. If the company does well, the value of your stock may increase, but if the company struggles, the stock price could fall. Bonds, on the other hand, are like loans you give to a company or the government. In return, they pay you interest over time. While bonds tend to be less risky than stocks, they usually offer lower returns. Mutual funds and ETFs are collections of stocks or bonds, which means they spread out risk by diversifying your investments. Instead of trying to pick individual winners, you can invest in a whole group of companies or assets. But how can a teenager actually start investing? If you're under 18, you'll need a custodial account, which is an investment account set up and managed by an adult, like a parent or guardian, on your behalf. Once you turn 18, the account can be transferred to your name. Setting up a custodial account is relatively easy with the help of an adult, and many platforms and apps make it simple to start investing with just a small amount of money. Some of these platforms even offer educational resources to help you understand what you're doing and how the market works. When you start investing, it's important to have a mindset focused on learning and growth. You don't have to be an expert right away. In fact, you might make mistakes, but those experiences will teach you valuable lessons. It's a journey of understanding how the market operates, what makes an investment good or bad, and how your emotions might affect your decisions. One way to learn without the risk is by using stock market simulators. These are tools that let you practice investing with virtual money. They're great for understanding the basics and seeing how your strategies work without the pressure of using real money. Another essential concept to understand is risk tolerance, which is basically how comfortable you are with losing money in the short term for the potential of higher returns in the long term. Some people are more risk-averse and prefer safer investments, while others are willing to take on more risk for the chance of higher rewards. As a teenager, you have a long time horizon, meaning you can afford to take more risks because you have many years to recover from potential losses. However, it's crucial to balance that with what makes you feel secure and confident. Diversification is another key principle in investing. It's the idea of not putting all your eggs in one basket. If you invest all your money in a single company and that company performs poorly, you could lose a lot of money. By spreading your investments across different companies, industries, and even types of assets like stocks and bonds, you reduce the risk of losing everything. Even though diversification can't guarantee against loss, it's a powerful way to manage risk. As a teenager, your primary focus should be on building good financial habits. Along with investing, it's essential to learn how to budget, save, and manage your money responsibly. Your investment journey can start with just a small amount, and as you earn more money through part-time jobs or allowances, you can contribute more to your investments. Investing isn't just about money, it's also about growing your understanding of how the world works. Companies, governments, and even global events can affect your investments, so being aware of what's happening in the world is part of becoming a savvy investor. Setting goals is another great way to stay motivated. Think about what you're investing for. Maybe you want to save for college, a car, or even your future home. Having clear goals can make the process more meaningful and exciting. Take time to read financial news, watch educational videos, and even talk to adults who have experience in investing. Learning from others and staying curious will help you make informed decisions. Finally, remember that investing is not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. Markets will go up and down, and it's easy to get scared when you see your investments losing value. However, staying calm and sticking to your plan is crucial. If you invest in well-diversified funds and give them time, history has shown that your investments are likely to grow. It's a lifelong journey, and the sooner you start, the better your chances of financial success in the future. So take that first step, keep learning, and remember that you have the most valuable asset on your side, time.